Hello everyone, this is Professor Kent, and today's recording is to record chapter 7 and chapter 7. The first part of, I'm going to do two parts for this. First part will be just to record the PowerPoint and go over the PowerPoints, and the second part will be to go through some of the examples and the homework questions at the back of the chapter. So that's what we will be going through. So now when you do that in this chapter, chapter 7, what does chapter 7 does? It just it shows you what it does is shows you the income and an income and a losses from property. So that's what we were going to be talking about, is the income and losses from the property. Then when you go to the introduction of it, I think my PowerPoint moved. So if the PowerPoint moved, I know. So what happens is that this will be a good schedule to look at it. When we think of as a good schedule, is what goes under the property income or losses. It is included in individuals' income based on the calendar year. So based on the calendar year, when we think of a calendar year, we think of a January to December. But your company year could be different. But when we think of from the individual purposes, we file our taxes on April 30th. When we file our April 30th, it looks at the calendar year, not the physical year. So the source of income cannot have inventory. So source of the income, where the income comes from, it cannot have an inventory, but it can have a depreciable and non-depreciable assets in that. And it does not include any capital gain or capital losses. So property income does not have any capital gains and losses. When we are doing the first one, what we're looking for here is we're looking for income from property, the concept behind it. Like determine whether activity is business or a property based on a level of an activity. When we think of a property income, it is a passive activity. It has little or no effect, simply waits for the returns, right? And the business income exceeds the passive level, requires additional ongoing work or a service. So that becomes a business income. So going further, what includes it? So I highlighted it to make to remember things easily. See, source of property income, where is the income comes from? It can come from where it come from an investment type. You could have an investment type property. When you think of an investment type, you could invest into shares, and when you get invest into shares, what you're going to get a dividend income. Then we have if you have a property, you have a lot of money, you bought a rental property, and you're going to have a rental income. You have a money, you give somebody, you loan to others, or you put the money in the GIC, then what we have called an interest income. And now if you are writing a book, so you have a royalty income on that, so that is also income. And now it's returns in form of interest and dividend from ownership of, if you invest money in the mutual fund, and what we're going to get interest and a dividend. That is also part of my property income. When we think of a income from property versus business, the important things, what is allowed, what is not allowed. So again, if the determination is income from a property, CCA cannot be used. CCA cannot be used to create or increase a rental loss. So you have a rental income, and then what you're going to do is you're going to deduct your CCA. When you deduct your CCA, you cannot create a rental loss. You can only do CCA up to the rental income. You cannot create a rental loss. Or if you already have a loss, you cannot create you cannot create a more bigger loss. CCA is not subject to shorter fiscal year rule. So you're allowed full CCA. You're not you can It's not subject to shorter years. So capital gain deduction is not available. So there's no capital gain deduction available. Our RRSP contribution are based on the earned income. So when you think of an individual earn their income, passive income is not part of their earned income. So if it's not, which is CRSP contribution are based on the earned income, which includes the business income. But so you can include your business income, but you cannot include in a property income in your earned income to calculate your RRSP contribution. RRSP contribution is 18% of the earned income. So the business income is included in that earned income, but the property income is not included in that. So now what we have is when you learn this when you did an intermediate accounting or your basic accounting. So what we do is if you have invest in bonds, what we do in premium and discount, we have two things you learn: present value and a face value. If present value is less, then you're gonna have a discounted bond. If the present value is more, you're gonna have a premium bond. So what the premium and the premium and the discounts are amortized. So this is what we're doing when you have a premium discount that are amortized. What we do is when we do accounting, we record they're part of my interest income. They're part of my interest expense. So they're part of your interest expense. One increases your interest expense, the other one decrease your interest expense. So that's what happens. So when you have a interest income, so what we're doing is you have an interest income. When do we have interest income? When we lend somebody money, we have an interest income. Or you put money in the GIC, that is also an interest income. So in this case, we're technically thinking of a debt obligation. So what we have is interest must be accrued on each anniversary date of the investment contract. So what we do is we call it accrual method. Even though you haven't got paid for it, you calculate the interest income. So what is the anniversary date? Is the day before the day in which the debt obligation is issued, not purchased. And every successive 1 year interval measured from that day. So this is how we calculate our interest income. And sometimes it makes it easy to do go through the example and what do we mean by accrual interest income, interest method. So what have a 5-year 100,000 bond is issued on July 1st 2024 with the annual interest of 10%. The interest payment for the first 2.5 years was 25,000. So what happens in this case, how they're calculating it, multiply by the 10%, which gives you the 10,000. And then what we're doing is for multiply by the 2.5, which gives you your 25,000 due on the 26th. Remaining interest will be paid on the 2029. When we think of an accrual, so what was the accrual? We think of it, when did we do it? We issue this bond on July 1st. We go through a calendar year. My calendar year ends on December 31st, and this is a 6 months. We don't care when the money is going to be paid, and what we have to do is we needed to know how many months are gone by. So so we issued the bond on July 1st. There's 6 months, but our calendar year is January to December 31st. So how are we going to calculate it? We issued a bond. The value of the bond was 10,000. They pay interest 10%, and 6 divided by 12 will give me a 5,000. From the corporation perspective, full accrual method is required. So what they do is they are going to be including 5,000 into their income. They're going to be paying it taxes on that. Now, however, from the individual perspective, they use a modify accrual method. So what is a modify accrual method is when they're going to get paid. In this case, we issued the bond on July 1st 2024, and what happens is that they will not be recording any income in the 2024, but they will be paying 100% taxes on the full year. So on a full year, so no income inclusion. They will not be reporting any income, interest income for as a, even though we issued it on July 1st, because they're using a modify. So what they're doing is they're not going to pay any taxes in 24, but when they file their 25, they're going to pay taxes on the 100,000, where it is 10,000, where it's different from the corporation. They use the full accrual method. Now, when you think of a full accrual method, this is over the life. So what they, we were to think about it, this was for, it is for 5 years. So this bond was issued for 5 years. So for the individual, they're not going to do anything, but at the end, you're going to be paying the taxes on the full. Doesn't matter if you are an individual or you are a corporation, but when you pay the taxes, it's different. So in this case, the 5,000, depending on their anniversary date. So this is where it is going to be calculated. So under the corporation, what you're doing is you have a half year here, you have a half year here, but the rest is you have a full year. So that's what happens. But when you have an individual, the individual is not taxed. They're using we call it something called a modified accrual. We call it modified accrual method. So that's what happens. So saying that when you have it, 25,000 of interest is due on December 31st 2026. So it is due, what they are doing is it's due, the 25,000 is due, which is 2.5 years gone by from that perspective. The half year here, 1 year is here, 1 is here. So if I already reported the 10,000, I will report the other 15,000 on that year. That's how we do that. And same thing, then you're going to have another 2.5 years when you do that half year here, and then you do the payment is you calculate the payment according to that. Rental income. The general rule for the rental income is your profit from rental activity include an income of an accrual basis. Cash basis is allowed if net rental income or loss nearly same as accrual. If it's the same as accrual, you could do the cash method. Otherwise, you will be forced to do the accrual method. Now, but if you have a rental income, you are allowed to, you're allowed deduction. You can reduce that rental income by deducting the interest on a mortgage. You have utilities, you have a property tax, you have any repair expenses. If you have a management company that is looking after your account, or CCA is restricted. What is it restricted on? You cannot create a rental loss or increase your loss. Now, the rule for the CCA is, of course, that goes to chapter 5 of your CCA. So we have a class 1, they will take 4%. If the building was built before the 1980, acquired before the 1988, you will do 5%. So if you have a land does not depreciate, so there's no CCA on that. So separate, if you have a rental property, you can have more than one rental property. You will have a separate class for each rental property with a cost of more than $50,000. So again, CCA cannot increase or create a rental loss. So that's what we can say that. Now, if you have a dividend, so what happens is we have a dividend. If you invest into shares or you invest into mutual funds, the company gives you a dividend. There's two type of dividends. First one is from Canadian corporation. So first one is a Canadian corporation, and then you'll have a private corporation. So first one is dividend received by, this is by received by dividend. You will include that income, dividend income to dividend included in the income of shareholders when it's received, not declaration date. You know from your accounting, you declare the dividend when you that is not relevant. When it's paid, that is irrelevant. So when we think of who is a taxable Canadian corporation, it is incorporated in Canada. This corporation is resident of Canada and not exempt for Part 1 taxes. If dividends do not have to be paid in cash, dividends are taxable when it's paid. That's what it means. Now, dividends are not taxable if it's not a capital example, not a capital dividend. We're going to talk about CDA, so we're going to talk about that later on. Now, dividend does not have to be paid in cash. You could also receive the dividend if there's stock dividend. That's also a dividend, or dividend in kind. That's another one. Now, when you receive a dividend, this is the next slide. When you receive a dividend from the individual perspective, you are going to gross up your dividend. So what do we mean by gross up? So when whatever dividend you receive, we have to gross up, and that means the gross up will increase the amount of dividend that you are receiving. So that's what happens. So dividend grows up. When we think of a grows up dividend, so sorry, sometimes the system gets hung. That's the problem. So when we think of like we said, that dividend received by individuals from taxable Canadian corporation are grossed up. It means it increased by the amount that reflects the income tax paid by the corporation. So what happens in this case, what we're going to do is we are going to gross up the dividend. So the gross up amount for the both, it is different from the public corporations and private corporation. So first one, we're looking for taxable Canadian corporations. So so when we have a dividend tax credit, they have to be grossed up, and then what we're doing is we get a dividend tax credit. We reduce our liability by getting a dividend tax credit. This increases it, this will decrease it. So what it does is it decrease your it decrease your tax payable. So the tax payable amount is decreased when we so let's go further. And then when we think of it, if it's we call it when it's a public corporation, we call them the dividends that you receive from a Canadian corporation, we call them eligible dividend. If you get it from the private, we call them non-eligible. So that's what happens when if you received a dividend from Canadian public corporation, they're subject to higher income tax. The range is between 23 to 31st to 23% to 31%. So now when we think of a gross up, so the gross up amount is 38%. So that's what happens. So when you are receiving a dividend from a public corporation, you have to gross up the dividend, and this gross up amount is your 38%. So that's what your dividend gross up is, 38%. So now going further, and then if it's that is the eligible dividend gross up amount. Now if it's a non-eligible dividend, the gross up amount is you have to remember that for the test purpose, for the non-eligible, if you receive it from a CCPC, which is your private corporation, you have to gross up 15%, but if it's from a public corporation, you have to gross up 38%. So that's what happens. So now going further, like if you look at it, when you do your eligible dividend tax credit, the eligible dividend tax credit eligible is from public corporations. That's an eligible. You get a dividend tax credit of 6 and 11% of 38% of the dividend. So it applies to the gross up amount. So the 6 and 1% that applies to the gross up dividend. Then what happens in this case, what the book does is it extracts the most of the question in the book, it does it with 6 and 11 of the gross up amount. So for it is for a purpose integration, provincial territorial is 5 and 11. So what we are doing is we're going to get 2 credits. One will be your federal level, one will be your provincial level. So the federal level will be 6, your federal level will be 6 and 11, and your provincial level will be 5 and 11. So these, you add both of them when you're calculating your dividend tax credit. Dividend tax credit, you have 2 of them. One is 6 over 11 and the second one is 5 over 11. When we think of one is provincial and one is your federal. So going further, let's go to when we think of a non-eligible. So that was your eligible. When we have a non-eligible, what we do have is you will see what you will see. You're going to have a federal and provincial. Your first one will be 9 and 11. For the provincial will be 4 and 13. These 2 numbers you needed to remember them. One, it is on the gross up amount. So it is on the gross up amount. So you have a 9 and 13 and 4 and 13. And if the dividends are non-eligible, if it's a non-eligible, it will be from your private corporation. So it's from the private corporation. Going further, I'm writing with my fingers. My fingers are working, but my pen isn't working. But sometimes it takes a little longer to get my pen to work. Now it's back. So now it's in comparison of investment returns when we do that. So you could be getting an interest income. These are the income tax rate that the individual will pay according to what they are receiving. So when we think of a capital gain, only half of the capital gain is included in the income. So if your gain was, if your gain was $10,000, half of that will be taxable. So you will only include $5,000 into your income. So you have a non-eligible dividends and eligible. Eligible is from the public corporation. Non-eligible is from your private corporation. So these are your taxes according to where you are. So if you're in Ontario, that's what you will be paying the taxes. So if you are in Alberta, you will have a different tax brackets, and if you are in Quebec, you will have a different tax bracket. If you invest into the mutual funds organized as a trust that allows for allocation of investment income to individuals. So what includes in there? What includes in the mutual funds? Distributor. You could have a capital gain, you could have an interest, you could have an eligible dividend, both eligible and non-eligible, or you could have a tax-free capital dividend. Certain amount is allowed as a tax-free. You could have a foreign investment in mutual funds, that we call it a non-business income. Or you could have a distribution of a capital. That's what you could have, a distribution of a capital. Mutual fund corporations tax at a regular corporate income tax rate on the investment income. Individual investor, what they do is they hold shares and they will be called shareholders. That's what they will be called them. If you buy the shares, you will be called a shareholders. Distribution or dividends subject to gross up and tax credit, usually for eligible dividends. Remember we said that you have a 6 and 11 plus your 5 and 11, 5 divided by 11. Now, when we think of these are some of the things that you could read over. It is when you have when you invest shares in the mutual funds, and what we have is we have ACB. ACB is the cost adjusted cost base, and that is now is not changed after the dividend distribution. Your ACB stays the same. So what happens is if the return of a capital made by the corporation, ACB of the shares reduce and no income inclusion. If the dividends are reinvested, what happens is the company pays you dividends, and that dividend gets reinvested into the company. The cost of additional shares added to the ACB of the original shares. So what we have is ACB from the old shares, ACB of the new shares that are purchased through the dividend that was reinvested. When we think of a capital dividend are tax-free dividend. We do not pay taxes on the capital dividends, and what we have is achieve a tax-free status if election is made. You have to do an election in order to get a tax-free dividend by the private corporation that has a capital dividend account. First of all, you have to have a capital dividend account if it's a private corporation. If you don't have a capital account, you're not allowed to do an election. When you do that, what happens is capital dividend account accumulates amounts of a private corporation that are tax-free. For example, life insurance proceeds, so and half of the capital gain on the net of capital loss. So if you have a capital gain, what you're going to do is half will be taxable, half will be goes to the CDA, and that you can take it out free. Corporation first declares a regular dividend, then files an election to treat the dividend as a tax-free capital dividend, and then to reduce the balance. So the company first, they have to declare a dividend. That's what they have to do. And then what they have to do is, if they don't want to pay taxes on that, they have to file an election, and then they can do it. Then they can have this dividend paid out to them as a tax-free dividend. If as a corporation, you could have a cash dividend and a stock dividend. Now this is a stock dividend. Stock dividend is treated like a cash dividend, so there is no difference between the cash dividend or a stock dividend when we think of a taxes. But you think of an accounting, yes, you issue new shares, and when you issue new shares, what happens is that you have more shares you own. If you have more shares that you own, from the accounting perspective, transfer of a retained earning or a surplus to the corporate share. So what you do is I'm just going to show you the entry. We have a stock dividend, and then credit will be your common shares, or some companies what they do is they charge it to the retained earnings. So that's what the accounting and treatment will be, the accounting treatment. That's what they're saying. But under the Income Tax Act, they look at it, we call it a paid up capital. So we call it PUC. It's a paid up capital. PUC is basically equivalent to accounting for share capitals. That's how do we account for share account. What it does is amount of dividend equal to increase and up. So when happens is, when you are dividend that are given to you, doesn't matter if it's a stock dividend or a cash dividend, if the amount that is given paid to you as a dividend, it will increase your PUC, and the amount of dividend added to the ACB, so it will be added to the adjusted cost base. Now, what we have is resident of Canada subject to worldwide income. If you're working in the US and you're resident of Canada, so if you're resident of a Canada, but you work, if your company is in US, you will have to pay taxes on the worldwide income. So what we call it a foreign source of income, will be taxed in both Canada and the other country, but you will get a tax credit. And what happens is that this will avoid paying taxes, double taxes. If you, this will be avoid paying taxes. You pay the taxes there, you pay the taxes to Canada, but then you are going to get a foreign tax credit to offset the double tax. That's what happens. For non-business income, so you could have a foreign non-business income. What that include? You could have a capital gain, you could have a rental property from the foreign properties. It is called a passive income. Or you could have an investment. On that investment you could be getting a dividend interest income. Minimum tax credit is 15% for the individual. That we learned in chapter 4 and chapter 5. Now permits the amount in excess of 15% to be deducted against the foreign non-business income. That's what happens. Now when we think of a shareholder's benefit, what happens if you own a corporation and you are a shareholder. Shareholder benefit is examples of a property income includes the amount where individual is a shareholders of a corporation. So what you're going to do is you're going to include in the property income. What are you going to include? If you have a low or interest free loan, it will increase your property tax. You'll pay taxes. If you're given an automobile to drive, right? So that will increase your property income. You are given a ticket to go travel. It's not a business related, non-business related. That will increase your property income. Cash withdrawal from the corporate bank account or for a personal expenditure. So you have a company's bank account, and from there what you're doing is you're taking out money for what? For your personal use. If it's you're using it for personal expenditure, you have to include that income into a property income. So this was there's more will be detailed coverage of this will be covered in volume 2. We're only doing volume 1 in this chapter. So chapter 15 we're going to talk more about it. This is it for the PowerPoint for chapter 7. We're going to do some examples and we're going to do some homework questions at the back of the chapter. Thank you so much for listening to me. Don't forget to subscribe to my channel and keep so that you could get access to the new videos that are posted on a regular basis. Thank you so much and take care and bye for now.